Okay, hello everybody. Welcome to Korean Atlanta Mentorship. Have you ever thought what would happen if you paid off a mortgage in 2.5 years? Well, I asked ChatGPT and I said, if everybody paid off their 30-year mortgage in 2.5 years, would the banks collapse? And the answer was yes. So let's go ahead and read that out loud and see what ChatGPT has to say.
Yes, it's extremely likely that banks would face severe instability, and some could collapse if everyone suddenly paid off 30-year mortgages in 2.5 years. Let me break down why, step by step. How banks profit from mortgages. Banks lend money for a home, say 300 kel, and charge interest over 30 years, say 6%. The interest is their main profit. They may also sell mortgage-backed securities. Over 30 years, the total interest paid can be hundreds of thousands of dollars. 2. What happens if everyone pays early? If all borrowers pay off their mortgages in 2.5 years instead of 30, banks get the principal back quickly, but they lose almost all the expected interest. Banks rely on interest to cover operating costs, pay employees, and fund other loans. 3. Liquidity shock. Banks don't typically hold enough cash to absorb millions of simultaneous early repayments. They invest mortgage payments in loans, securities, and long-term assets. Sudden repayment would flood banks with cash, but much of it would need to be returned to homeowners. Banks might not be able to return all money at once without selling other assets at a loss. 4. Economic ripple effects. Mortgage-backed securities would crash in value. Investors, pension funds, insurance companies could take massive losses. Banks would tighten credit or fail, triggering broader financial instability. The housing market could be affected. Banks might refuse new mortgages, slowing the economy. 5. Historical analogies. Prepayment risks exist today. Some borrowers refinance to pay off early, and banks price that into the loans. But no one has ever seen 100% of 30-year mortgages paid off in 2.5 years. That's an extreme systemic shock. Bottom line, while banks would get the principal back quickly, losing decades of interest and facing a massive liquidity shock could cause collapses, bailouts, or at least a severe credit crunch. If you want, I can make a rough back of the envelope calculation showing exactly how much money banks would lose if everyone did this at once. It's surprisingly huge. Do you want me to do that?
No, that's okay. I actually understood everything except for part three. I don't understand the returning money at once to the homeowners, but everything else I think I understand. But yes, this is why I made the thumbnail. Banks will hate you for this, right? It's kind of like there's an old school ad about like a language professor, like language professors hate you for learning Spanish in like 2 months or something like that. So that's what we're gonna do today. Velocity banking possibly pay off a mortgage in 2.5 years. And by the way, if you don't know who I am, I paid off my mortgage in not in 2.5 years, 2 years and 9 months. So that's a little bit more than than 2 years and 2.5 years. But yes, I did pay off a mortgage in 2 years and 9 months. Actually, let me play that Vine Boom sound again. Let me say that again. I paid off a mortgage in 2 years and 9 months. That's better. Okay. I'm not that really that good at sound production, but might get better in the future. And another thing too, if you don't know about me, is that I have over $739,000 in credit cards and lines of credit. Yeah, I do. I do. So here's the secret to all of this. Actually, it's not a secret because I've actually been doing these demonstrations for the past 2.5 years over and over again. And I'm not hiding anything. I just tell you all, tell you how it is, and hopefully you take it a run. But I think a lot of people are so passive nowadays. Like you give them the answer, and it's like you didn't tell me the answer. You know what I mean? That's why like me in the I guess teaching guru space. I feel like I could just tell you everything I know, and then like you're probably not going to do it because that's just how life is nowadays. I don't know what it is. It's like the internet. Remember how the internet was supposed to replace college, and then ChatGPT? Everybody say, "Oh, AI is going to replace jobs and stuff." I don't think so. And you know why? Because humans like confirmation from other humans. So when you type in stuff in ChatGPT, you might want to pay someone to say, "Hey, is what ChatGPT is saying true?" Right? And whoever's very confident in their answer, they could still make money. I truly believe that, right? Because remember when everyone says, "Well, if you could Google it, why would you pay a professional?" I don't know. Same thing with AI. If you could just AI it, which is just kind of like another form of a search engine, why would you pay a professional? So you might want to think about that. Anyways, so let's go ahead and possibly pay off a mortgage in 2.5 years, even though I pay it off in 2 years and 9 months. Do velocity banking, same situation again. And how do I always present it? Especially if you're new, right? I just present it like this. There's no such thing as velocity banking. I just show you, hey, do you make good income? Look at this. You only have $1 in your checking and savings, and look at all the debt you have. 10 credit cards, an auto loan, a mortgage, okay? And you have $3,000 of expenses to pay every single month. And you only got $1 in your checking and savings. What's the main question you got to ask someone new when you want to present velocity banking, or at least when I do it? I just ask them, like, do you need to make more money? Get out of this hole. Everybody's going to say yes. Everybody you know, okay? Everybody you know will say yes, right? And so here's what we're going to do. We're going to show that with the same income and the same expenses, we don't necessarily have to make more money. We just need to kind of control the flow of money. And, it's kind of like a fire hose, put it in a different direction. All right, so now what's the first mental hurdle from doing velocity banking? Well, it's just simply not saving money, right? So if you show two, if you show people two different situations, is it better to save $1 or nothing? I think they'll want to save $1 or $10 or 100, right? And what we're going to do is that as we're paying off debt, right? As we're paying off debt, we're not going to save any money at all. Like saving money is kind of being frowned upon in when we do velocity banking. And you might be thinking like, well, what if we have emergencies, right? That's what lines of credit are for. So what we're going to do is the difference between here and here is what's our main operating account? Where do we put our money, right? Here, we put our money into checking and savings, right? It's the final destination of our money. Whereas velocity banking, checking and savings is like the middleman. So you want to see how this works? Well, basically, you take a look here. You see 19,000 comes in, 19,000 goes out, but we don't leave that money here. See, most people, if they ever had 19 or 20, 25 grand or 100 grand coming in, they'd want to like keep it in their checking account and hold on to as much as possible, right? Whereas if we have debt, we can't do that because if we're saving money at let's say 1 to 4% and our debt is at a higher interest rate, we're losing money by holding on to that money, right? We're losing money. Okay, that's literally how a bank works. So remember how in the 80s the interest rates were so high, right? Like I think it was like 17, I don't know, 12 to 21%. I'm just making it up, right? Well, why they do that is because they loaned at higher than the amount of interest you were getting in your savings account, right? So that's why like when the interest rates were like 3% for borrowing money, you only got like 0.001. I'm just making this stuff, but you get what I mean, right? So I don't have the exact figures, but that's kind of the principle of banking. Like if you're saving money, they're loaning it out at a higher interest rate. So what we're going to do is just pay them off really quickly. And if we pay off, let's say everybody pays off their mortgage really quickly, the banks will collapse according to ChatGPT, right? So we don't. Actually, I don't know what would happen if the banks will all collapse. Everybody pays off their mortgage. Would we be a free society? I don't know. I have no clue. All right, so now what we're going to do is focus on this cash flow number. Okay, this cash flow number. And so what we're going to do, okay, is that we're going to move some debt into something called a line of credit. So what's a line of credit? It's basically a financial tool where you can borrow money, pay back, and then use it over and over again. So this is my home equity line of credit, home equity line of credit for $373,500, right? $373,500, and look at that. Basically, you just click a button like this, transfer funds, and then you just take money from the line of credit into the checking account, and bam, it's there, right? It's just there, and it's like, whoa, okay, like it's so quick. Like you should see these banking websites where you just click the button and then voila, you have $1,000 in your checking account. Now they do charge you interest, like 8%, 10%. This one's like 15, right? Like the highest I've ever seen on a line of credit is 15. Although by law, 18% is like the maximum interest rate on on a home equity. And I don't know if there's a limit on a personal, but usually I've seen 15 on a personal line of credit. So like I said before, I have over $739,000 in lines of credit and credit cards, and a credit card is a form of line of credit. Yeah, don't forget that, right? Because you can swipe it, pay it back, and use it over and over again. So the line of credit, what makes a line of credit different from, let's say, a loan is that it has a two-way flexibility to use that line of credit. Like we don't like if we overpay a loan, we can't get that money back, right? It's very hard to get the money back if you overpay a loan. But if you overpay a line of credit, you can easily get your money back. But your credit card's a little bit restrictive, but it's basically the same principle. And I think a credit card is technically a loan. Like it's so confusing. Have you ever seen like, oh, get a loan from your credit card, or get a line of credit from your credit card? I was like, isn't a credit card line? So if you go to into the weeds of the naming conventions, you'll realize none of it makes sense and it's all the same in a way. But just from a layman's perspective, credit card, line of credit, two-way street, loan is a one-way street, right? And so we're going to assume we have a free and clear $200,000 line of credit. Now, here's a secret to getting credit, right? Here's what people don't understand. And you can just kind of type this in ChatGPT. Banks don't lend money to people who need it. So if you need money and you go to a bank, they'll just like laugh you out the door because what they want is a safe bet. So someone who's attracted to low payments over time and will do it for a long time, which is how a 30-year mortgage works. See, there's two things a bank hates. Number one is a person who's not going to pay you back, right? Because what is the problem with a person who doesn't pay you back? The bank loses principal and interest, right? They loan you $10,000 and then you just don't pay them back after the first payment. Well, they lost like pretty much $10,000 and the additional interest that they were going to expect it to make, which is their profit, right? So now they're in the hole. Now the other thing they hate is people who pay off their debts too early because yes, they got their principal back, but where's their profit, right? It's like you don't want to run a business where it costs $10,000 to run and you get the $10,000 back quickly, would and then you don't get any profit on top of that, right? Like no one wants to work. It's like flipping a house. You spend all this money and then you sell it and you made absolutely no money flipping the house, right? That's the same thing. No bank wants to get paid back early. That's not how they make money. It's the way that they make money is getting small payments over time from you, right? Small payments over time. That's how they make money. Now, would a bank lend you $200,000 in the form of a line of credit when you have $1 left over? Pretty much no. And the reason why they wouldn't do that, okay, I'll tell you why they wouldn't do that, is because you're a huge risk, right? So except for 2008, banking is about mitigating risk, right? Like I heard that in 2008, like you just sign a mortgage and you just kind of state your income and they'll just let you buy a home and that somehow crashed the economy, I think, right? So yeah, so that's why they don't lend money to people who need it because people who need money, I mean, in the bank's point of view, don't pay you back, right? So a lot of it's just risk mitigation. So yeah, so banks don't lend money to people who need it, and people who need money are uh, very bad according to the bank's eyes, right? Now, why do we have a free and clear line of credit here? It's because number one, I'm lazy and you can clearly see the benefits even if you have a free and clear line of credit. And then number two, I've put more realistic scenarios behind a 99-cent paywall. So if you want to see some crazy scenarios like 22 debts, $4 left over, I got that in the paywall, right? I call it the PhD of velocity banking. So if you want to see that, go there. There's another one where it's like $7,000 a month of income. I think it was like 15 debts and then $1,000 left over. I remember when I first saw that scenario. Okay, I remember when I first saw that scenario, I was like, wow, this is like the PhD of velocity banking. And then once I got the scenario of the 22 debts, real life scenario, 22 debts and $4 left over, I was like, I'm demoting this one to a master's. This 22 debt scenario is going to be the PhD of velocity banking. And you know what? I should probably create a PhD course, right? So let me just kind of show you here of what that one is. It's actually the most viewed live stream on the channel, 22 debts, and it's paid. Look at this, 284 views. People are loving it. Let me actually show you here. Um, I've watched this video over 22 times. I don't know if you can see it. Actually, let me zoom in so you can see it. The comment. I've watched this video over 22 times. Sometimes I watch on TV and other times a phone. Phone, yeah. This guy's definitely what I call a velocity banking cult member, devoted follower, right? And so, you see this, and right here, the most useful video on the internet right now. Okay. So, 22 debts, 99 cents. I'm undercharging, and I know I am, right? So, anyways, so because I'm lazy and I like to do the same scenarios over and over again, and my excuse for being lazy is the Bruce Lee quote: "I don't fear the man who does 10,000 kicks once. I fear the man who does one kick 10,000 times." And so you might be thinking, why do I do the same scenario over and over again? That's how I become the Bruce Lee level of velocity banking, right? Bruce Lee and velocity banking. Actually, let me just do this, okay? I'm actually going to ask ChatGPT, can you create an anime picture of Bruce Lee doing velocity banking? I have no idea what's going to show up here, but let's see what happens while we're doing our velocity banking presentations. All right, so now let's go ahead and do this. So what we're going to do is use a formula called the cash flow index. So it's basically the balance divided by the payment. And then what you do is you just get you get a number, right? So it's kind of like a ranking number. The lower the number, right? The lower the number, that's basically saying, hey, pay it off early, right? And the higher the number, that means pay it off last, okay? Because it's all about bang for your buck. So what does this high number mean? Well, basically, I essentially have to give someone $200,000 to get $843 back in my life, right? Whereas here, with these credit cards, I can just pay off this 35 grand credit card and I'll get more in my cash flow than paying off a $200,000 mortgage. So we're thinking of terms of efficiency in our cash flow. And I think there's just really one exception to this, where if you have a very low number, but then like you got a 0% loan, that is possible, but it's going to be negligent anyways. If you really kind of compare, end up paying a little bit more interest in that scenario. That's like the only exception. So, but I think this is a great model to figure out which debts to pay off. And I remember I actually didn't fall in love with the cash flow index until I did the 22 debt live stream. I was like, how do I figure out which debts to pay off? Right? So this was a learning experience for me too. Mind blowing. Right? So let's go ahead, and that's what we're going to do today, velocity banking. And then, so you see right here, we have all these credit cards and all that, and so what we're going to do is move these low cash flow index credit cards into the line of credit. So it's going to be 5, 8, 15, 27, 30, 7, 10, 35, 12, 15, and then we're going to sum it up. It's $164,000. So what we're going to do is move $164,000 of credit card debt. Are you freaking out now? $164,000 of credit card debt, and move it into the line of credit. And guess what happens here? Okay. Okay. Guess what happens here? Well, basically, this $1 turns to $5,111.83. Oh my goodness, how did that happen? Did you see how we didn't make more income? And so when people see this, they're like, what? But they know that you haven't really manipulated anything, right? Because we're using Excel. We're using basic functions like a minus b, right? Or a plus b. Not really complicated math. Okay, so that's what we're going to do here. And now the final step is to dump all of our money into the line of credit. You put this 9,600 here, take out the 4,000, and then after every single month, the balance will go down about 5,000 and some change. And then so now it's 5111.83. So the formula is you take these two, previous month's balance, previous month's interest, subtract our cash flow, right? And then to calculate the interest, it's based on the average daily balance multiplied by the interest rate and then divide by 12, all right? 0.08 divided by 12. And then what we do is copy and paste, and then see where we go here. It takes about 37 months to pay off the credit card debt. Yeah, so 37 months, that's what we're going to do, 37 months, and then it's going to be 164K, right? 164K, all right. And then I'm going to copy and paste this. And then you see that we have only 2 more loans left and we're good. So let's go ahead and do this right here. So we see we have this loan calculator right here. See, you just put these 3 factors, the balance, the interest rate, and the term. It'll spit out a payment. You type in the current month, it'll give you the current balance. And then we follow the cash flow index here. And then that's what we're going to do. All right, so I'm just going to do this right here. And then bam, so now this is plus 16045.43. And then, okay, this is going to be 0. Okay. All right, so now we update our cash flow, 830.58. And then, so there's going to be 39 months. And then now it's 204K. 204K. Okay, so now it's time to take a chunk out of our mortgage. So what does that mean? You just kind of small bite-sized pieces, we'll say $10,000 for our monthly income expenses, and then we just put the information here, and then now it says 2.5 years. So even if I use a 30% credit card, the amount of interest that we'll pay, actually, I might even argue, because a credit card has a 1 month floating period, I don't think the interest would actually be this much. Now, this is assuming they're calculating the average daily interest. If you take a look right here, there's this little thing that calculates daily interest. But if you have like a $10,000 credit card and you're paying it off every single month, I think the only fees you'd have to pay is if you're paying with the credit card is probably like that 2.9% transaction fee on Plastique if you're using Plastique. But the reason I just talk about this is because people say, "Oh my goodness, 3%. What? 30% credit card. Why would you do that?" And I'll tell you why I might do that is because maybe I want $739,000 in lines of credit. So the best credit decision is not the best financial decision. Okay? So you might really want to think about that. Okay? I'm not telling you what's right or wrong, but I'm saying, hey, not everything's black and white like people want to show you. Okay? So, all right, $739,000, 2.5 years, paid off a mortgage. And if everybody paid off a mortgage in 2.5 years, I think according to ChatGPT, or well, ChatGPT says the banks would collapse. All right, let's see if our Bruce Lee pick. Whoa, look at that. That is so cool. Oh, Bruce Lee doing velocity banking anime. That is so cool. Why is Bruce so cool? Why is everyone whose name's Bruce like it's not like a name like John, you know what I mean? There's always something that stands out about somebody named Bruce. Like Bruce Wayne, Bruce Lee. What's another Bruce? I had a math teacher named Bruce, and he was a weird guy. Honestly, kind of a weird guy, probably, but he was cool too at the same time. All right, well that's it for today, folks. This is Korean Atlanta Mentorship here with another video. And if you watch to the end of the video, just type in "Be water, my friend." Be water, my friend. And if you don't know where that's from, I'll just type it here. Be water, my friend. That's a Bruce Lee philosophy. So if you want to let me know that you made it to the end of the video, type in be water, my friend. Okay, well, that's it for today, folks. Korean Lanta Mentorship. See you all next video.